Daniel, the floor is yours.
All right. Thank you so much, Markus, and thank you everybody for hosting me today. I'm going to make a brief introduction to the company. I understand that understanding Grifols and the plasma industry is not an easy thing, but I would like to move forward and give you the opportunity to bring so many questions. Markus was mentioning, that over the last year or years or so, especially because of the COVID, the company was underperforming. But it's very true, and I'm sure that you guys have the chance to discuss at the same time how we are projecting the upcoming month is pretty exciting, with the sense that Grifols is in the rebound. Things are moving in a much better way, especially on two things that I will explain a little bit later. Plasma collections. Plasma is our raw material, really needed to produce and then commercialize plasma-derived therapies. This is a really important piece. We are exceeding pre-COVID levels as we speak. So the worst part of the COVID impacts have been left behind. And the second thing, and it's even more important, is cost per liter, is pretty much how we are running our costs. We had a significant increase because of the COVID, because we had to pay more to our plasma donors, and because all the technology and the fixed costs, because of the lower volumes that we were collecting, during the COVID, it had an impact in our cost per liter in terms of the allocation. Things are getting much better. We are seeing a really meaningful reduction. So that's why we expect that our margins, taking what Markus was mentioning, that are today in the range of 20-21% EBITDA, that we should be able to bring them more to high 20s as we had in 2018. But again, before moving all these pieces, let me introduce a little bit more the company, especially for those that are less familiar with Grifols and with the plasma company. Grifols today is a global healthcare company, present in more than 30 countries. The heritage is there, more than 110 years of legacy, really focused on improving standards of safety and quality. At the end of the day, we are talking about plasma-derived therapies, biological products. So all these standards really important. At the same level, innovation, try to bring more solutions to our patients is really key. As Markus was saying, today, moving more from 6 to close to 7 billions at some extent, is what we are projecting for this year and next year. Market cap, after all these challenges, 6.5 at some point in 2019, early 2018, actually right before the COVID, the market cap of the company was close to 20, or at some point exceeding 20 billion. So I'm living here, but it seems to us that there is a really large opportunity. Fundamentals strong, no changes, solid underlying demand. So with the sense that is more, to fix those main items, main issues, plasma collection, cost per liter that I was mentioning, to have a real opportunity to be back where we were in 2018. Okay, so today, Grifols, 3 business units, really focus on these 3. Bioscience is the most important one. Bioscience or biopharma is the most important one, 80% of the total. Then we have a small division on the diagnostic field, especially in terms of screening plasma and whole blood. And then there is a really small piece, but with high margins, that is biosupplies. Biosupplies, to give you a brief introduction, is more the plasma that is not used to produce plasma-derived therapies. We are using it for non-therapeutic use, basically selling it to research company or to other diagnostic kind of companies. But again, I would like to focus your attention to the bioscience that at the end of the day, as said, is 80% of revenues and something similar in terms of EBITDA contribution. To give you a little bit the picture of the market, I would say there is a very different, in terms of growth, sustainable growth, very, very different than other healthcare spaces. Plasma-derived market over the last 15, almost 20 years, it has growing and growing in the range of 9-10% every single year. So really what I'm trying to say is that the cycle of our products very, very different than other healthcare companies. You cannot patent a biological product. This is key. So no, we don't have the threat of potential generics, while at the same time it's a really small industry in terms of players. It's more than 20 billion market, but pretty much 3 players, 4 players. Key top players, more than 70% of the global market. If we're putting the focus in the US, that is the most important one by far. 90% of the market is pretty much on CSL, Grifols, and Segarra. So it's a pretty concentrated market. And basically the main reason is because the barriers of entry are very, very high. So we are in a really good space now in terms of performing and in terms of growth and high margins. In short, the company basically backed by 4 pillars. Innovation, such an important thing, bringing more proteins to our patients is really key to make sure that we are delivering on our mission, but also from a plasma economics or from a financial perspective is really important. Bear in mind that any new protein is 80% margin accretive, gross margin accretive. Donor is paid, running plasma centers is already paid, and part of the industrial process is the same regardless the protein that you're producing. So that's why it's so important to keep pushing on innovation, bringing more proteins in our commercial portfolio, and make sure that we are not only fueling top line, but also the margin expansion of the company because it's so accretive. Plasma is really key, is our raw material, as I was saying. I would not like to define Grifols as a pure plasma company. We are defining ourselves as a biopharma. So our expertise is in a few therapeutic areas, pretty much 4 or 5 therapeutic areas. So bringing plasma-derived therapies or other type of therapies focus on these therapeutical areas that we have a lot of expertise is really key to understand what's the company today and where we are moving. So innovation, I said, really key. Plasma is at the core, but it's not the only type of medicines that we are providing. Industrial is really, really key. I said, we are leading with biological products, so making sure that we are meeting the highest standards in the industry. In so many cases, setting them is such an important thing. I will say that historically the company has been very well recognized because of its industrial excellence. Global expansion, I said, it was initially a family-run business, very, very focused on Spain, Portugal, then Europe. Today, 75% of our operations are in the US. So it's a really global company, 30 countries, very, very focused on US first, China, and then Europe. Germany and Spain are the most important ones. We are running a network of close to 400 plasma centers, a leading company, so making sure that we have all these centers to collect plasma from our donors, especially from those countries that we can compensate our donors. Is the case of US, is the case of Germany, and some other countries in Europe. So going deep, said, I'll focus on a few numbers of therapeutic areas. We really need to put the focus there. It doesn't make sense to us, to have a broader spectrum of therapeutic areas. We have 3 hubs: US, important; Europe, it's another hub, important for us. And then, we have a leg also in China. In the US, pretty much we have 2. On the west side, California, San Francisco, LA, San Diego. And then we have commercial headquarters, R&D headquarters, also in North Carolina. We cannot do everything on our own. That's why we were consolidating. We made some acquisitions over the last years to bring those capabilities that we don't have internally through the acquisition of other companies, but also through some collaboration programs. Biotest, as maybe you are familiar, is the latest acquisition, is a pure plasma player, but the rationale of the transaction was pretty much accelerating our innovation pipeline, bringing 2 proteins potentially in 2-3 years from now. Hopefully, we will be able to reinforce our commercial portfolio. 2 new proteins, no additional cost, 80% gross margin, as I was saying. So really important, really creative on that sense. Very briefly, the company, a lot of growth over the last 8-9 years. We were able to bring our plasma center network from 150 collection centers to close to 400 with a more global footprint in more countries. So diversifying our plasma sourcing is such an important thing. Plasma, it has been always strategic asset, I will say. And the COVID-19 situation, lack of product, getting access to immunoglobulins, that is the main protein on our portfolio that is directly related to the immunodeficiency system, is really key. And an increasing number of countries are being more aware about the importance of self-sufficiency. That's why Germany made a really step up a few years ago, trying to increase, the capacity to collect its own plasma. And there are a few more examples. Egypt, Canada are moving towards this goal. Maybe you're aware there is potential new legislation in Europe trying to bring some flexibility, some changes in terms of compensating our donors at some extent and making sure that the dependency of the US plasma is a fact. Industrial excellence, I don't want to spend a lot of time here. We have so many facilities around the globe, a lot of presence in the US, 70-75% of our operations are right there, a very significant number of plasma centers, as I was showing before, are right there. We have a lot of presence in Europe, but also in China, really large opportunity, really important, really significant among some other countries. This is pretty much our global footprint. And let me pause here. I would like to explain a little bit more our plasma economics. It's not a really slide, I gotta say, but again, it is important to understand, what we call plasma economics. Very, very different than so many other companies. Producing, as I was saying, producing 1 protein, 10, 15 proteins, pretty much the plasma cost is the same. That's why we're putting this red line flat. But if we're able to put more proteins in our portfolio, really, really creative. Commercial market is not the same for every single protein. That's quite clear. IgG and albumin, as you can see, are the largest one. That's the reason why it's so important to put more proteins through commercial efforts, through R&D, to expand both lines, because it means that we will be able to sell more product of the existing proteins, but at the same time, we will be able to increase our revenue per liter as we will be including more proteins in our portfolio and seeing a more revenue per liter. What I'm trying to say is that unfortunately, the commercial market is not the same for every single protein, as you can see here, but it's so creative because the plasma cost is already done for the existing proteins, especially for IG and albumin, that as you can see are those that we are producing the most. We are able to see a really meaningful margin expansion if we're able to keep pushing on innovation, accelerating it, and bringing more proteins in our portfolio. I don't know if you have any questions here. We can take any Q&A.
Okay. Thanks for the explanation, Daniel. It's very, this is very interesting how companies, explain the fundamentals and how the financial guys, sometimes we are far from what is really the, the calculation, how the business is evolving. So thanks for that. So do we have time for, I think the main question for us, if I may, is the company has faced the fundamental challenges since 2019 and before, and the stock price has reflected that with a big fall. Maybe you can explain us what are the main mistakes that you made, the company made, or fundamental, not mistakes, fundamental challenges, and what the company, not cyclical, but more structural, and what the company is doing now to be back to normal.
So, main challenges in short, back to what I was saying in the beginning, was lower collections. During the COVID, it was, we had a significant impact. 35% of our collections declined. You remember, no public transportation, everybody, lockdowns, everybody much at home. So the decline, the drop was very significant. Then, especially in the US, we saw that a lot of financial aid across the board. So the incentive to donate, to get out from home and going to a plasma center, that at the end of the day, it's like a center, right? It's not an open kind of activity. It was really, really hard to get the plasma that it was needed. So that's why, we had to increase compensation, try to make the whole process a little bit more attractive. And then from an accounting perspective, when the volumes of our raw material plasma went down, the allocation of fixed costs went high, right? So the total cost per liter increased by 40%. It was huge impact. Pricing was there. We got some price increases, but we were not able to pass through the whole 40% increase in our cost. Where we are now, we are exactly in a very different way. Collections, really large increase. Last year, 25%. Finally, meeting and exceeding 2019 levels. First quarter, 11% additionally. So with the sense that plasma is no longer an issue, collections. And the second thing is that we are seeing a meaningful reduction in terms of cost per liter. Two reasons. Donor fee is declining. The whole context, is supporting that we don't need to pay the same level of donor fee we had to pay during the COVID. And the second is that we are really implementing an aggressive plan. We expect to see cash savings for more than 450 million per year compared to 2022. So it means that we should be able to bring our EBITDA from 1.4, that range, 1.4 to close to 2 billion in a relatively short period of time. Operational leverage is important. All the technology, all the structure that such a global and large company has, it's important. So we are reversing. We are really seeing, how the whole situation has been reversed. It's true that the inventory accounting takes 9 months. That's why we are really positive saying how our cost per liter is getting down. We said in the first quarter, more than 15%, driven by a more than 25% of the donor fee. We will update this number, but I'm sure that in the second quarter it's going to be higher because the whole situation is supporting it. Lower donor fee and the execution of the plan that it was announced mid-February will be even more meaningful. So we really believe that a significant margin expansion is coming in the second half this year and next year. And the reason is because the inventory accounting is pretty large. The working capital, it takes 6 to 9 months. Things are in our balance sheet and we're going to see in our P&L again in 6 to 9 months from first quarter this year.
Thanks a lot. We maybe have time for one single question from the audience. I can maybe also say that Grifols has now a Swiss CEO. And I can also say that Octapharma, which is one of the competitors he showed, is actually headquartered in Lachen, where we have the offices. And they're trying to build a Glassen Palace right at the lake, which I think shows a bit about the profitability. In the case of Octapharma, it's a privately owned company from Heidelberg, but they pay taxes in Canton Schwyz in Lachen, and we like that. One question, and otherwise we would have to stop, otherwise we go into overtime, and I hate to be the nasty guy here.
I have just one question about the financing side. I think that was something the market was a bit worried about. If you could just speak about how you're financed, how you look at the refinancing, this thing. Those are longer maturities, but still the market is a bit talking about that.
Agree, is one of the main concerns. Debt is pretty high. Over the last years, we made some inorganic acquisitions. The latest one, a really good one, was Biotest, but really unfortunate kind of timing. But certainly is priority number one. We are working on 2 directions. Everyday improvement. I was mentioning close to 2 billion, in 2024. It should means a significant organic leverage ratio reduction. And the second thing that we are working to make some disposals, significant ones. We would like to raise something in the range of 2 billion plus, that it will be an important step forward to see meaningful reduction and make sure that we will meet our commitment, that is to report a leverage ratio of 4 times by 2024. If we're able to go through this process as expected, and we're doing good progresses, we should go through, the 2025 deadline, and then we don't have any commitment until 2027. That we really believe that the whole situation of our balance sheet is going to be much better by then, because of the large growth expected, upcoming growth. And then we will see more meaningful the contribution of the 2 proteins that we acquired through Biotest.
Daniel, thanks a lot. Great applause from Switzerland. We have some sun here as well in Switzerland. And I heard that it was raining a couple of days ago in Madrid, so I think we can be lucky not being on this side. With that, I would like to pass on to Urban.
Thank you, Alex. Thank you, Danny. And thank you to Ralf Weber from Julius Baer, who joins us today. We really appreciate that he's coming and presenting Charles Schwab as an investment case. He's a veteran investor, has been at Julius Baer for over 20 years, and oversees a big portfolio of value investments, about which he'll talk a bit in just a second. Thank you, Ralf.
Yeah. Thanks a lot. So there are now after me 2 more speakers between me and the lunch, so I will speed up a bit to catch some time that nothing gets cold. just a bit who we are. Bank Julius Baer. I think most people know Bank Julius Baer. It's the largest pure play wealth manager in Switzerland. Roughly 426 billion assets under management, approximately 1 billion profit last year. And one thing which is still special about Bank Julius Baer, although we have grown over time, I think we are still small, especially in investing, and so we keep the teams very focused, very small. And on the value side, for example, we were never than 4 people, always between 2 or 3 people with voting members. I joined Julius Baer in 2000, entered the special value team 2015, and since then we always developed the team further. When you look at our special value strategy, currently 4.5 billion assets under management, 1.5 is also is a public fund called Special Value Fund, and the rest is mandates for clients starting at 1 million. Then, quick look at our track record. We have strategy in 3 currencies, also Swiss franc and euro, but as we do some partial FX hedging, so we always hedge back 50% of the currency exposure for our Swiss and euro clients, it was better to show the US dollar performance. There you can see, since inception, we compounded money at 7.5. Like many value investors, we had also some struggling 15 until 2020. That's why we added also a value benchmark just to keep us sticking to a value strategy and do not style drift like some managers did and then regretted last year. Last year, we were down 4-5%, so we were clearly value. And when you look at the year-to-date performance, yes, we are lagging a bit the market, but I think for a value fund like we do it, up 6.9 as of end of April is still a very good number. What did we do in terms of strategy? I think at the beginning, when Ed Frauenfelder launched the strategy, we were more on the left-hand side, a bit similar like Warren Buffett being, so looking for cigarettes, buying them, and once they're up 10-20%, moving on. But the problem was it less and less as we worked, and as we also increased in volume, it was becoming more difficult. So over time, especially on the contrarian side, since the big disruptors appearing on the floor, like Amazon, most of contrarians there, they were priced for a reason. They were often value traps, and so we really reduced that exposure to roughly 5%. We still like classic value ideas, which is very flexible. So at the moment we have roughly 10% in energy, 5% in commodity stocks. We also own two of the higher-end German car manufacturer. So these are classic value stocks, decent dividends, and usually PE around 6-7 times. But I think one segment where we really started buying more value thing is a bit the Warren Buffett style, looking for the wonderful companies, the compounders, and then it was just our trick, just being patient, looking at them, and when they get out of fashion due to temporary problems, then we buy them. This is a bit what we do on that side, and that's also why I will present Charles Schwab today. Because the nicest thing, often something like SVB or Credit Suisse happens, and then everybody says, yeah, banks, I knew it, they're bad. So everybody's selling everything, and this can sometimes offer great buying opportunities. So Charles Schwab at the moment, it looks like a contrarian, it looks like a typical value stock, but when you look at their track record, it's still a wonderful company. They just have one problem. They have a lot of deposits, and they were refinanced at least over 5 years. So they had to take some losses on the balance sheet, but that's the only problem. And if the clients still believe in Charles Schwab, which they do actually, so the clients still adding more, bringing more money, the company gets even stronger, and it will just starting to reverse over time. So quick look at Charles Schwab. So the yellow line is EPS. It was compounding at 19% per annum over the last 10 years. When I look at stock performance, it more or less always caught up again, trading around 25 times earnings, quite a decent price for a financial stock, but yes, it has much higher return equity than most of the others, around 15-20%. And then 18, it offered the first buying opportunity when everybody was thinking interest rate would stay at 0 forever. And now, earlier this year, we got the second buying opportunity. So how is Charles Schwab making its money? Here I have just the business mix. The biggest bulk, although it started as a discount broker, it's no longer trading fees. Because when Robinhood and some others started offering for free, they said, we can do it as well. We don't need it. Because when you look at the dark blue line, they make most of the money with net interest margin. So just taking the cash which clients keep on the cash account and investing into risk-free assets like treasuries or mortgage bonds. It was around 60% in 18, and now it has dropped even to 40% 2 years ago or 1 year ago. 1 second. One thing which is amazing, so Charles Schwab, just remember Julius Baer, 426 billion assets under management. Charles Schwab is now nearly 20 times bigger than Bank Julius Baer, so it has a lot of leverage. And they have one of the greatest IT platform just to take in this money, reduce costs for the client, and repeat. And when you look at over time, they're taking now in at the rate of 200 to 400 billion in a year. So it's amazing. And it's the same again. Money comes in, people start investing 90%, 5 to 10% is more or less the average on cash. And on that cash, that's where Charles Schwab makes most of the money. Yes, this March, some of the clients were also fearful, but they did not run away, but they were buying treasury bonds, they were buying money market funds, and that's why some of the cash amount clearly came down from 6.5% to 5%. But when you look at the numbers, it's just huge. So client deposits, 430 billion, 13, and equity is only, so was at the beginning of the year, 56 billion. And now, after they took the loss on the balance sheet, it went down by 20 billion. And in our opinion, this will reverse now, and Charles Schwab is still highly profitable, so they do around 7 billion a year, so this should be only temporary. What was the problem? Already outlined. Now there are big alternatives. So if you have more than enough cash, you don't need to put it there. You can also put it into money market funds. But often, as the average client has only $20,000, so it's not just the millionaires or billionaires are there. So many, when they trade, they just keep some money on the cash. That's why we are pretty convinced that they will, more or less over the next 1 or 2 years, they will move back to normal. They will get more assets, and this will make the valuation very attractive. Here, just the bond book. How was the hit? So they're very open how they've invested it. So most was in agency mortgage and treasury bills, 4-year duration. But the hit was huge because they own 333 billion at the beginning of the year, of last year, and now it's 306 billion. But one thing, they don't want to do it. They don't want to sell it. That's why they are borrowing at the moment roughly 40 billion from the Fed, because otherwise they have to take the hit already. In terms of maturities, so you see well spread, 4%. And yes, in hindsight, they could have done better in 2020, just buy short-term treasuries and wait for yields to go up. But like most, I think they did not expect the move go so fast. So what's not possible? Or what could be worst case? I think if bond yields go to 8-10%, then Charles Schwab is ready for a capital raise. That's always the problem if you own banks, and then when they're down the most, they raise capital. But in our scenario, we rather think inflation will go back to maybe 3%. So 3% will be the 2%, so the new normal. And if you have 3% inflation, then I think the current level of 3.5%, 4.5% is pretty reasonable. And then it's a great opportunity for Schwab just to go back to normal and have decent earnings. How is the valuation at the moment? 14 times earnings. It used to trade at 25 earnings. And the interesting thing is, so this year the market is expecting earnings to drop 20% due to higher financing costs. But next year it should already start to go up again, maybe at 15-20% a year. And what's then possible in terms of scenarios? If you take some some P's. If we say 15 times earnings, so that's the trough of now, or 18, then we land around $80. So 44% upside. If you say people realize it, it's a great compounder. It needs 20 or even 25, then you can see the stock can even go up 90 or 140% in the next 3 years. That's the story of Charles Schwab. Any questions, if I still have time?
Yeah, you do. You were very compact and lots of interesting content in limited time. Thank you. So, who would like to go first for a question for Ralph?
Can you explain again, why are you not concerned that the 300 billion in deposits are not going out and not moving into money market funds? Because then they would be forced to sell more of their bond portfolio now.
I mean, you have the whole history. So Charles Schwab clients, they tend to own between 11 and 15% cash. More than half was always in money market funds. But a big part is what I said. So people buy something, sell something, and in the middle they keep it some cash. And maybe always going into money market fund. If you just do trade, it's still a discount broker. So many clients maybe do more short-term trading. So there will also always be some numbers there. And one thing which makes me more convincing, because once Schwab gets every year or every month new money, the number of just holding deposits will be even less in terms of assets under management. Yes, short term it's clearly risk when the Fed is offering 5.2% like risk-free money, but I think this 4 or 5% should stay. And for us, it was a very nice sign that client did not move out. So actually, they had one of the strongest inflow in March when SVB and Credit Suisse both failed or had to be saved.
Thank you very much. Is there another one? We probably do have time. If not, thank you so much. Thank you for coming.
Thank you.
And big round of applause. Thank you, Ralph.
Now it's my pleasure to introduce you to Peter Frech. Peter Frech has a master's degree in psychology. So we have red chairs. We should have maybe red sofas. He has been joining in 2007 Quantex group. And since 2008, he has been an extremely successful value fund manager. Lucky for us, competitors. He did a soft close. So he has been really very successful. And we are extremely happy to have you here, Peter and his colleague, Livio Arpagaus.
Yeah, thanks, Alex, for the kind introduction. So our case is Petrobras, but first a few words about Quantex. We are not, contrary to the results, we think of ourselves as not very smart or sophisticated value investors. We're looking for value at plain sight. We're not good at forecasting operating margins or tax rates in 2042. So we're really looking for a margin of safety and the obvious cases. So who are we? We're a small fund boutique founded in 2003. We have FINMA license since 2008. 5 fund strategies and about 2 billion AUM in total. Here you can see the team. Basically, the fund management of the value strategies is done by the 3 guys on the right side. So that's me, Livio Arpagaus, who's with me today, and Moritz Nebel. And how do we work? Basically, our investment process is very much quant-driven. So we try to get rid of all these behavioral biases where you always look at the same companies, the same sectors you feel comfortable about. We try to get rid of that by doing quant screenings to generate IDs. So we do global quantitative screenings all the time using Bloomberg, but also empirical research, which is an external research provider. And they generate IDs for us. And we're basically screening for cheap stocks, mainly based on free cash flow yields. And then we do a very short quality check. So we don't dig very deeply. We don't do site visits, we don't talk to management. It's just a rather short quality check. And the main question here is, why is the stock so cheap? Because we're screening for dirt cheap stocks, and we try to understand why is it cheap. And the main question is it a temporary problem, a solvable problem, maybe a cyclical downturn, maybe there's an image problem. Now a lot of companies have image problems for ESG reasons, for example, but there are also country discounts, British stocks after Brexit, etc. These kind of image problems we like. What we try to avoid is companies that are cheap because they have a potentially deadly problem. Secular decline stories, over-leveraged companies, especially over-leveraged cyclicals. These we try to avoid. So we're happy to buy into cheap stocks, but we try to avoid the potentially deadly value traps. And we also look at capital allocation because we screen for free cash flow. We want to know what management is doing with our free cash flow. And we like it to get it back because usually management over time, they tend to do empire building and doing a lot of crazy stuff. So we prefer a high cashback yield. Then we do a rough valuation, not very sophisticated fair value estimates, discounted cash flow, but really very, very, very rough and basic. And out of that, we build a portfolio of about 40 names. So it's rather concentrated. And what's special here is we equal weight them as well. We don't want to have any favorites in our portfolio. I think that's psychologically dangerous if you have favorites, big overweight positions. So we do the equal weighting, and we also do the rebalancing to keep the equal weights. And how we look at risk or our strategy or philosophy in general is this winning by not losing approach. So we basically see two risk dimensions. One is kind of operating leverage, how stable or unstable are the cash flows, free cash flows of a company. And the other dimension is financial leverage, basically the cash flow obligations coming from the balance sheet. And by doing these two dimensions, you get 4 quadrants. And basically we say there's one quadrant, we call it the death zone, the red quadrant, the upper right quadrant of companies that have unstable, cyclical, or declining free cash flows and a lot of financial leverage. And we don't want to invest there at any price. And that's a difference to other value strategies that say, yeah, well, if it's cheap enough, we buy anything. We say, no, if there's a serious risk, the potentially deadly problem, company might go out of business in a recession, in a credit crunch, in another COVID lockdown, whatever, then we don't want to touch it. That doesn't mean that you can't make a lot of money in the death zone. I think a lot of value investors can make a lot of money, but you can also easily blow your brain out there. I think it's really tough. You have to be good at timing. It's emotionally, psychologically stressful to be active there. You can make a lot of mistakes, especially when it counts the most. So we try to avoid it and focus on the other quadrants, cyclical companies with no leverage or leverage companies with stable free cash flows like tobacco companies. So coming to our case study, Petrobras. Just as an introduction, it's one of the largest oil producers, producing about 2.6 million barrels of oil equivalent today. It's mostly oil, not much gas. Oil is produced in Brazil, mostly offshore in these relatively new pre-salt discoveries. And the Republic of Brazil controls 50.3% of the votes, not of the capital, but of the votes. We own, like most other investors, we own the preference shares that have no voting power. So valuation, I think that's really value plain sight. Free cash flow yield on enterprise value, that's current Bloomberg numbers, 36%. Free cash flow yield on equity, it's 55%. Dividend yield is 48%. So not only there's a big free cash flow, you also get it all back as a dividend, or even a bit more of that. And so it's really dirt cheap. There's a huge margin of safety, and yeah, that's basically it. Any questions? No, obviously there are always some questions, so I try to answer some of those. Why is it so cheap? I think that's kind of the quality check. It's obviously dirt cheap, but why is it so cheap? So we think there are potentially 4 reasons. Bias against Brazil, maybe financial leverage, maybe oil cyclicality, maybe corruption and political risks. So bias against Brazil, you can clearly see that if you look at some current numbers. For example, in red, you see current inflation rates around the globe. And you see Brazil actually has a lower inflation rate than the US, the EU, UK. It's been the case for the last 2 years. They always had a lower inflation rate than the major Western countries. And despite that, they have a way higher interest rate, central bank rate. So you get very high real yields in Brazil. And on the other side, you get very negative real yields in other countries. And also, overall, government debt to GDP looks way better in Brazil. They have way less debt than other Western countries. They have way better demographics as well. So we would argue that Brazil has very sound finances, but is suffering from a kind of an image discount. And you also see that if you compare Petrobras to other oil majors, which are more or less of the same size. You can see here, last year, Petrobras generated about $40 billion of free cash flow. It's more or less the same as Chevron and Shell produced. But the enterprise value and also the market cap of Petrobras is just 1/3 of the others. So there's a huge valuation discount despite having a very profitable company. Now maybe there's a risk with regard to financial leverage, but there isn't. There maybe was one a few years ago. You can see here the green bars are is the net debt position, including financial lease obligations, and you see almost 10 years ago they had over $100 billion of net debt, so that was a concern, but that has been massively deleveraged. It's now down to 40 billion and change, and net debt to EBITDA ratio at 0.7 is very low. And also the debt maturities, weighted average maturity is 10.7 years. So I think there's no financial risk at all here involved. Now maybe it's the cyclical risk that keeps the stock cheap. Is it more cyclical than others? No, it isn't. The actual production or lifting costs of its oil barrels are very low. These offshore oil fields, they have very high initial capex requirements, but once you get the fields pumping, you have very low extraction costs. It's just $5.50 per barrel. On top of that, you get taxes, etc., and then DNA, obviously, the government's take. So all in, you get to about $33 per barrel. But if oil prices were to fall, obviously, government takes will also go down. So even if we get into recession, oil price drops to $30 or maybe even $20 for a while, I think that wouldn't kill Petrobras. So there's no deadly risk for the company coming from oil cyclicality. Then maybe it's corruption risks. Well, that's a serious concern. Petrobras was the victim of a big political corruption scandal a few years ago during the offshore boom. A lot of money was paid as kickbacks from Petrobras to newly founded Brazilian companies to do all the offshore servicing and exploration, etc. And this led to a huge scandal, and a lot of politicians were involved and also convicted, including the current president, Lula da Silva. He was convicted for this corruption in 2017, but actually the trial was nullified in 21 for procedural reasons. So yeah, there was a serious case of corruption in the past, the big kickback scheme going. But the question is, will they really try to do this twice and hope to get lucky twice and not land in jail, especially now that everyone is closely watching their moves? And also consider that Lula's party in Brazil is just holding about a quarter of the seats in parliament, so they don't have a majority. It's a more or less evenly split country with regard to political sides or partisanship. So they're closely watching whatever they're doing, and also the regulators, the jurisdictions, etc. I think they will closely watch what they're doing. So I think there's maybe some corruption risk, but I don't think that it will kill the company. It didn't kill it the last time, and I think this time it's even way more unlikely that something like this will happen. Lately, there's another discussion coming up with regard to, maybe the president is trying to get Petrobras to lower fuel prices, gasoline prices in Brazil for the Brazilians. That may be an issue because they control the board due to their voting power. But on the other side, the board members still have a legal obligation to look for the interests of shareholders, so they just can't give away the gasoline for free. I think that would not be according to their legal obligations as board members. So I think the risk there is also not that big. There might be some token political changes coming, but I think it won't kill the company. So overall, conclusion, I think the discount really seems mostly to be based on image problems, mainly due to ESG. Everyone hates oil companies. And then Brazilian politics, there's a big discount on emerging market companies in general, and maybe Brazil in particular. But I think that's the main reason for the big discount. I don't see others. There's some risk of future capex misallocations, obviously, maybe with regard to corruption, but also with regard to ESG investing. Yeah, they're trying to force Petrobras to invest more in solar and wind offshore production. They probably waste $1 billion or $2 billion or maybe $5 billion, I don't know. But with 40 billions of free cash flow and 40% free cash flow yields, you can afford to do that. It's still a lot of margin of safety in the valuation. And we also like the very high dividend distribution as a protection against that. As long as we get these very high dividends, we're not that concerned. If they were to cut the dividend massively and start ramping up capex for whatever reasons, then we would have to rethink our position. But for the time being, we're very happy with the place the company is at. So we think there's a very, very high margin of safety. And just as to end the presentation, a few words about our fund, the Quantex Global Value Fund, which is currently soft closed. So there's a cap on the amount of shares outstanding, but some shares are free at the moment, so you can still buy some if you like to. And here you see the long-term performance of our fund in black and the MSCI World in red and the MSCI Value Index in green. And obviously there was this huge outperformance run over the last 2 or 3 years. That looks impressive because of the scale, but that was rather easy. We had a lot of tailwinds as value investors. I think we're more proud of our achievements the 10 years before that, when it was very, very hard for value strategies. You see that the green line was way below the MSCI World Index to beat the index, and we were one of the very few value funds that managed to beat it. So, and the secret to our success was probably not the stock selection in the sense that we picked the best winners or anything like that, but that we avoided the worst losers. So we screened for cheap stocks, but avoided the death traps, the deadly value traps. And by doing that, we generated the outperformance. So that's my presentation. Thanks for your attention, and I'm open for any questions you might have.
Thanks a lot, Peter. And I must say that, Peter is a very humble person, because I think if you look at the track record, is among the top in the world. There is Fundsmith out there with managing 24 billion, still open for subscription, but Peter and Livio are beating these guys. But these guys are closed or soft closed, which I think shows a lot also on the personality. Now, I think there are for sure some questions, and I'm pretty sure that everybody of you over the mobile phone, over the Charles Schwab trading account, bought already Petrobras shares during his presentation. Yeah. We own Petrobras as well.
Just a friendly reminder why you should buy it.
We own Petrobras as well for our Natural Resources Fund. There is a question here.
Thank you, Peter. First of all, congratulations to your success. I know you for quite a few years now, and You said before that you managed to avoid the value traps, and that's a very hard thing to do. How did you do that?
Yeah, well, we still get into a lot of value traps. Obviously, that comes with our approach. But yeah, I think we can avoid some of the worst. This death zone companies where you have this risk of a permanent loss of capital. And that's kind of the trick. Everyone is trying to beat the market by looking for the biggest winners, the next Microsoft, the next Amazon, whatever, to generate outperformance. And we say, no, it's far easier actually to avoid the worst stocks than to find the best stocks. So if you buy reasonably cheap companies with more or less sound balance sheets, then you should do okay over time if you can avoid some of the worst value traps.
We can maybe have one more question, maybe at the very back. Because Peter's going to stay here.
Yes, I'm still here for lunch.
Could I don't know whether it's public knowledge, but could you tell us what percentage of the shares are held by you and the management?
In Petrobras, huh?
In Petrobras or
not in Petrobras?
in the fund.
Your fund. Yes.
Oh well, it's a rather low share now because the fund has become so big. Obviously, there's no performance fees, so there's not some kind of carried interest scheme going on. It's all the shares we bought with our own money over time. But all of the team have a significant amount of their personal wealth invested into the fund.
Thanks a lot. Peter is still here for further questions, and I think we will go now for the last presentation. Orban?
Yeah, thank you also from my side. It's great to have all of this different contrast and perspective, which leads me to introducing Markus, my colleague at BWM. He's a financial analyst, has been with the firm for close to 20 years, doing analyst's work, and I think that's what he does best, and I'm very happy that he will talk about one company with two names.
Urban, thank you very much. I understand this is a tough spot here for me now. I'm standing between you and lunch, but still I hope that you have as much fun as I have diving into an investment case. So please bear with me just a few minutes. I'd like to give you an introduction into our analytical process, our investment process. And I will use the French car supplier Faurecia, soon to be renamed Faurecia, as an example. Perfect. We are looking for the instances where Mr. Market is acting irrational. For that, we cannot value every company out there, of course. So every investment process has to start with the idea finding process. An idea meaning a company where we have good reason to assume it might be undervalued. To come up with such an idea, there are plenty of different possibilities to do so, and I listed just a few. I would like to emphasize today the first two. Number one, whenever we do a valuation and then we come up to the conclusion that the company is not cheap enough, we put that valuation in our watch list. So if for whatever reason the shares decline thereafter, they show up automatically as a potentially undervalued idea. With that also, we keep record of all the insights and information we ever got from interactions with the management, with industry experts, which we use often. And that together is an invaluable asset to us as it gives us access to the breadth of 25 years of experience in our team. The second point is attending an industry conference. That's a very efficient way to meet and get acquainted with companies you might haven't followed in a while. And that is actually how I got to know Faurecia. I attended the IAA Automotive Fair in Frankfurt back in 2013 and had a management meeting at the time. And again in 2017, same thing. I was, number one, quite impressed by the management team itself, but also I was impressed by the way they were describing the business of Faurecia. There was a lot to like about Faurecia, and I will come to that in a minute. What we didn't like and why we didn't continue the analytical work at the time was the company was controlled by Peugeot. They had a 45% stake, I guess, at the time. But when Peugeot announced the merger with Fiat to become Stellantis, they had to give up their shares. And that was the point in time when we got all ears. Now, let's step back into that time, early in 21. What did Faurecia look like? This is the breakdown of revenues by segments or product groups. The biggest chunk was 40% of revenues coming from the seating segment. They do full seats as well as mechanics and frames that you can see up here. The second largest segment was interiors, where they do door panels and instrument panels, the interior of a car. Then comes the clean mobility segment. There they do exhaust treatment systems like catalytic converters. And lastly, the smallest and youngest segment, electronics, where they do displays and cockpit electronics. The first thing we really liked to see was that in almost all of those businesses, Faurecia is the global market leader, the number one, highest market share. Second thing, especially in the automotive industry, is you might be concerned what's going on with the shift from combustion engine to electric vehicles. And already back in 21, it was good to see that 75% of revenues were powertrain agnostic. It was just the clean mobility, the catalytic converters, that are dependent on a combustion engine. And I'd like to remind you here that this business today is still growing, because globally in every market we have tighter and tighter getting emission control schemes. And also don't forget, all the hybrid powertrains still need a combustion engine. So this business for the next years to come is still growing. But the other segments are growing faster. And the other segments are outgrowing the overall automotive market simply because they are gaining revenue per share. They are gaining content per vehicle. Why is that? Looking first at the largest segment, seating. Seats are getting more and more complex over time. They are adding functionalities. Heating, cooling, massages maybe, crash protection. They include audio systems going forward. All of that is increasing the content per car. They are also getting more versatile. When we're talking about autonomous driving, eventually seats will be able to turn around 180 degrees or offer flat bed configuration. Another trend that is ongoing here is that all the functionalities that we are all used to in the front seat as a driver, most or many of those are also getting used in the rear seats in the future. All of that driving up the content per car. And the same trend actually is also visible on the interior side. While a door panel used to be a very simple plastic piece of thing, they will soon in the future be used also for cooling and heating the environment of the driver and the passengers. And they do so actually much more efficiently than using the air ventilation. And this is an important thing going forward when we talk about battery cars, because heat will no longer come for free, as we are used to. Those fundamental trends were also confirmed, not just anecdotally, but also in discussions we had with different industry experts through those networks, expert networks that we use. A few months after we bought the shares first time, Faurecia acquired the German lighting specialist Hella. This was a strategically very sensible move to do. The market loved it. The shares were up 12% on the day. I'll come to you in a minute what the problems were. But with the lighting business of Hella, where Hella again is one of the three largest players in the world and by far the number one with the German OEMs, that automatically increased the powertrain agnostic part of the business from 75 to 80%. And with the growth that we are expecting going forward, that will quickly go up to 90% already by 2025. So far, I talked about anecdotal evidence, things that were explained to me, things that we understood how the market works. But that was already visible in hard data back in 21. Here you see for the last 7 years, in blue, I guess, yes, the revenue development, and in green, the order intake rate. And in each and every year, the order intake rate is much higher than the actual sales numbers. So this shows you the company is on a sustainable growth path going forward. It's not just talking, it's hard numbers. The decline we are seeing in 20 and 21 on the revenue side, that of course is due to COVID and several related issues. There was just a lack of car production. And the uptick that we are seeing in 20, 6.5 billion of that is the acquisition of Hella, but also organically, revenue last year were up 17%. And on a side note, first quarter this year, revenues were up organically 18%, close to 18%. All of these are characteristics of businesses we would love to own. if we can get it at the right price. So that's where valuation comes in. And valuation means number crunching. This is the most important tool that we are using. This is our financial model, and it's just a small snapshot of the whole thing. It's a standardized model for all our companies, looks the same, makes working very efficient, very easy, also for my colleagues to jump in and join the discussion. In that model, we have, of course, all the numbers released by the companies, but also all kind of metrics we calculate ourselves on the valuation side, on operating statistics, and the like. The first thing we always look at when we get that to that model is what's the leverage, what's the balance sheet structure, how's the company financed. So let's look at this. Before we got into Faurecia, you see here the leverage ratio defined as net debt to EBITDA. The management has always been very, very prudent in managing their finances. Leverage has always been really, really low. When COVID hit and EBITDA went down, that's when the leverage ratio for the first time ticked up to 2.5 times, but also quickly reverted back to 1.5 times. That was for us perfectly fine. That's the time when we got invested. And as I mentioned, shortly thereafter, they acquired Hella. And with Hella, they improved the business mix. The whole business, the product portfolio is getting better, has a higher quality today, but it also added higher share count, and it added a huge debt load. So the high debt level that we are seeing right now, that is, I guess, one of the main reasons why the shares are trading so cheaply today. And we take that very seriously. We look at this very, very closely. And it's not just looking at the simple leverage ratio like here, we also look at what kind of debt do they actually have? What's the maturity schedule? What are the covenants? And from our perspective, from our analysis, we are very, very confident that this situation is under control. For one, the company today has enough cash on hand to repay all maturities upcoming in the next 3 years. And secondly, they are deleveraging quickly. They have already signed deals for their disposal program of 1 billion euros. So we are confident that towards the end of the year, they will get back to around 2 times leverage and quickly go down thereafter to their own target of below 1.5 times in 2 years. That was the debt level. Let's talk about what's the profit chances of the company. On the profitability side, it's a good it's a good way to get started with company guidance. That is often too optimistic, but it's a good starting point. And here you see the company guidance, and the first point is the sales number, and their sales target for 25, that is easily achievable, and it's already confirmed that the orders they have. And don't forget, in the car industry, orders today are not sales tomorrow. Orders today are sales in 3 to 9 years for the model cycle of that car. So the important part for us was here to look at the operating margin. To model the operating margin, we do that on a segment-by-segment basis. And here I show you for the largest segment, for the seating segment, how we approach that. This picture shows you for every half year of the last 10 years, or 20 half years, on the horizontal axis, the sales level, and on the vertical axis, the operating profit defined as EBIT. And the low point here on the left corner, the only half year where they had a loss in that segment, that was the first COVID period. And all the periods thereafter were impacted by COVID, by the war, by inflation, by all things that are just not normal. If you just for a second bear with me and we blend those out and we focus on the 6-7 years prior to that. And here we can plot in a trend line, and that's the operating leverage, and it's a good fit for a long period of time. So you see here for 100 euros incremental revenue, the company is able to earn roughly 10 euros in incremental operating profit. And we see no reason why over the next 2 years the company should be able to get back on that trend line. The growth we have already seen on the order intake, and with that they would achieve actually their 7% margin target. Another concern many investors have is it's an automotive industry, it's a cyclical industry, so what about a recession? And for that, just take a look at the state of the current global automotive market. Here you see for the last 20 plus years, car production in all the 3 major markets, Europe, North America, and China. And when you look very closely, already 2019, all major markets were producing below trend. But then COVID hit, first with factory shutdowns, then with supply chain issues. So we have now 3 years consecutively in the past with recessionary level of production. And that is not because there's a lack of demand, but simply the OEMs were not able to produce those cars. That makes us very confident that even if we get into recession this year, car production this year will be higher than last year's. Come to an end, we have to look at the valuation. This is a chart showing you in blue the 1 year forward and in green the 2 year forward price earnings multiple for Faurecia over the last good 10 years. And this is based on consensus estimates at the time. I'm including the 2 year forward because when you look at consensus estimates, 2 years is a pretty good proxy for what the market believes is a normalized earnings power, a sustainable earnings power. And on first sight, you already see that the company is trading cheaply right now. But if we look at the 1 year forward and we look back to this period of normalized of a normalized environment, so 2014, 15, 16, 17, 18, in that time frame, you see the company typically was trading at around 11 times forward earnings. And we could discuss whether they deserve a higher one today because the product portfolio has been de-risked. But we take for our base case this 11 times the earnings estimate as our base case valuation and come up to a value of 51 versus right today they're trading at around 20, a little over 20 euros per share. You might say this is overly simplistic, and I would agree. But coming back to the model that I showed you earlier on, with that model, it's very easy to look at different kind of valuation metrics as well. We can do DCFs, we do sum of the parts, we do EV/EBITDAs, free cash flow yields, you name it. Point is, all of those give me different angles looking at the same thing, at the valuation, and those different angles have to show me the same number, at least the same range of number. If we don't, then that means we might have missed something. There is something wrong in the model. Also, using that model, it's very easy to play around with the assumptions. Rather than just the base case, I can say, listen, let's assume the company actually achieves fully their targets. That means operating margins above 7%. I can see what the fair value would be then. Or the other way around, I could say, listen, I just don't trust them and they will not be able to improve their margins at all. And I could see what the valuation would be then. And this is the summary chart that puts it all together, the whole story. The blue line is the share price performance of Faurecia. And the red columns show you when and how much we bought. And the thick green line, that is the base case assumption for the fair value. It's not a static number. It gets revised, of course, when new information comes along. And you see the valuation range that we put around that. In a summary, I hope I was able to show you not only how we think and how we work, giving you a little insight into our alchemy kitchen, but also I was able to show you that Faurecia is a good company with good businesses that are not impacted negatively by the shift in powertrain to electric vehicles, that is not impacted, at least not lastly impacted by recessionary forces, if at all, I would add this year. And also a company that has a debt issue, yes, but it's a debt issue that will very quickly be resolved. I mean, we believe it is resolved. You don't have an issue, but it will also be resolved on plain sight if you just go 6 months ahead. And this is a business that we really like, and it's a business we like to own. It has the right price, and it's trading at a significant discount to our fair value and its historic valuation. With that, I am open for any comments or questions you might have, or for lunch, and I'll be there as well if you want to have a discussion.
So I think we'll do again one question right there. Thank you.
Thank you. I think it looks like an interesting company, but I would like to know about the peer group situation. Why does an OEM says I will choose a product from Faurecia, not from another company? What is the competitive advantage of the Faurecia product?
Yeah. A lot of the things are actually patented, so you got a patent protection. And the other thing is the main barrier to entry, I guess, there is the client relationship. You don't want to mess around with those. When you get into a car, you are locked in for that model. And you typically get the follow-on contract when the model gets renewed thereafter. And right now, actually, Faurecia is declining orders. They get orders, or they get requests for proposals that they are not answering because of the high order intake rate they have, which also gives some confidence that they should be able to reach their margin target.
Thank you very much, Markus. Thank you all for being here today. I hope it was a value. Thank you.